Hi, and welcome to Futures Discovery at John Lothian News. I'm your host, Corties Draper, and on this program, we'll embark on the fascinating world of futures and learn from top professionals in the field. Today, we're unraveling the enigma of Contango and the world of futures trading. Join me as we delve into the intricacies of why futures prices for a commodity in the distant future can be higher than in the near future, exploring costs of holding physical assets, the role of storage, and the strategic implications for traders. Whether you're a seasoned investor or just stepping into the futures market, this is a journey you won't want to miss. Let's start by peeling back the layers of Contango. Imagine a situation where the futures price of a commodity set for delivery in the distant future is higher than the one set in the near future. Why does this happen? Well, Contango often arises from the cost associated with holding a physical asset, be it storage, insurance, or financing. Consider the cost of holding a physical asset as rent for its place in the future. Storage becomes a key player here, especially with commodities like oil. Storage costs add an extra layer to Contango, making it a challenging landscape for investors, particularly when they're rolling contracts. This can lead to potential negative roll yields. But there's a silver lining for producers and merchants. Locking in profit margins by selling futures at these higher prices become a strategic move. For speculators and arbitrageurs, Contango presents a playground of opportunities, from speculating on future price movements to seizing arbitrage opportunities. Yet beneath these strategies lies the tale of supply and demand. A persistent Contango could be the market's way of signaling anticipated abundant supplies or dwindling demand. As we navigate the futures market, understanding the nuances of Contango and its counterpart, backwardation, becomes crucial. So whether you're a seasoned trader, an aspiring investor, or just curious about the world of futures, join us as we decode the phenomenon of Contango and explore strategic implications for traders. As we delve deeper into this conversation surrounding Contango, let's talk to Clive Furness. Clive currently serves as the CEO of Contango Markets Ltd. And the Contango Hedge Company. With a wealth of experience and leadership in the financial world, Clive is the perfect guide as we delve deep into the fascinating realm of Contango. Clive, thanks for joining us today.
Thanks for having me.
Since Contango is so deeply embedded into your company's business strategy, can you provide further insights into the dynamics of Contango and how it impacts the futures market?
One of the reasons I chose Contango Markets as the name is that the Contango is fundamentally associated with the way a commodity merchant would hold positions in physical stock. Throughout the 24 years of this company, there have been numerous occasions when I've talked to commodity traders and they've just looked at the name on the card and gone, I know what you do, because it's so fundamental. And in essence, the Contango is just a price structure. It's a structure where the price is lower at the front of the curve than it is forward in the curve. And there's obviously the opposite, backwardation, which we'll talk about as well, because it's equally part of the landscape, particularly in commodity markets these days. But the Contango is invaluable for commodity trading firms. And the reason it's invaluable is that generally, not always, but generally, a commodity merchant or physical trading firm will be long of physical stock, which means that their hedges on the futures markets will be short to balance the contract out. If they need to roll those hedges forward, they need to buy back the short they have and replace that short in another futures contract month further down the curve. If the market is in Contango, there is a finite price at which the market will after which the market will start to pay for the interest on the value of the commodity, the storage, and the insurance, which are the three key things that are the costs in holding a position. So, for instance, when I was a coffee trader, essentially we would know at any given moment what the costs of holding product in warehouse were. So, what the cost per ton per month would be. We'd know what the insurance cost was, and we'd know what the cost of money was. And we would be able to work out exactly what the carry was for us. And the carry is the price that the market would have to give us with no cost from one month to the next. So say, for instance, the carry was $30. If the March-May position was at $30 discount, March to May, which is a contango, we would then be able to buy March and sell May at a $30 discount. Because we've made those $30, the market has paid us to hold that position costless for that 60-day roll period. And it's really important because that cash and carry is one of the things that makes, the business for commodity merchants. Because if you can, and you can find ways that you can get more competitive finance, you can find better, cheaper warehousing costs, and indeed in cheaper insurance costs, the more you can take costs out of those costs of carry, the more the contango is valuable to you.
Listening to that from a physical side of the assets, can we also get a perspective from a trader's side? Like, how does calendar traders or somebody interacting with markets use contango to make market decisions?
Well, they'll understand the full carry prices as well. I mean, any futures trader worth their salt will know roughly what full carry is. And will be looking at the markets. They'll be analysing the markets on a daily, possibly hourly basis, looking at the fundamentals, looking at the technical indicators, looking at all of the elements that they have available to them to make decisions on what they see as fair value, what might be out of line, what they might want to trade that's out of line, that essentially they're looking for the market to revert back to the mean. Whilst they won't be holding physical positions, they will be quite aware of the fact that there are people in the market who are holding those positions, and they will be looking for signs of those rolls happening, of large merchants starting to roll their hedge books forward, because that will be a sign that you'd probably start to see some movement in the front month to the second or third month intermonth spreads, the calendar spreads.
When rolling contracts during contango, how can traders mitigate or capitalize on challenges posed by negative roll yields in the contango market?
For me, a negative roll yield will be anything that's more than full carry. That would be so if the carry happens to be $30 on whatever contract it happens to be, if it's 29, it's one negative as far as I'm concerned, because I have a 30 carry cost and the roll's only paying me 29. Therefore, I'm losing out on that roll by $1. So therefore, my physical inventory is devalued by $1. And the further away from the full carry that the market gets, if I've got physical inventory that I'm holding and I need to roll my hedges, the more negative the roll becomes. What is of more concern for a commodity trader holding physical positions is when the market goes into backwardation. So the price of the front month is higher than the price of the forward month. Because up until that point, whilst you have a negative roll yield, there is at least something coming back to you from that roll, even if it's very little on the roll itself. The second you get to parity and above, so +1 plus whatever, so the front month being higher than the next month down the curve or the month you want to roll into, that starts becoming a very costly thing to have, because every single month you're doing that, you're holding stock and you're giving away money every single time you roll. The backwardation is, as I say, not the friend of the physical merchant, but it is something that the funds, who are massive in the markets, use to their benefit every single month that they can. A fund will generally be long of futures. That's, not every fund is always long, but very often funds are certainly long only funds, does what it says on the tin. When they come to roll, they're selling that front month, and they're buying a month forward. So that's the opposite of the contango, but still having the same financial impact, is that they're selling high, buying lower. They're actually adding value to their position because they've got no finance costs. They're actually adding the value of the backwardation to their position. So whilst it's not great for the physical merchant, it is good for the long holding fund.
The percentage nature of contango is linked to market signals, I would think, in some kind of sense, about anticipating abundant supplies or dwindling demand. How accurate are these signals in your experience, and how do traders interpret them when making decisions?
The supply and demand fundamentals are a massive part of the decision making that that traders will use to have positions, hold positions, take positions, unwind them, whatever. But they aren't the only thing. It's not the only thing. Money is a fundamental. The role of the speculator in the market is an integral one to today's modern markets. And whilst there are a number of Luddites out there who curse the funds every time they get into the market, I think one has to accept that money is a fundamental, and we have to understand money flows as a part of the supply and demand curve. But if I'm looking at from a physical transactions perspective, I have to look at the global supply and demand. I can't look at one region and hope to have a picture of a global commodity market without having the global picture.
What strategic considerations do you keep in mind when navigating Contango?
When we talk to trading firms, when we work with trading firms, the first thing we have to absolutely be clear is, what are the costs? What costs are you sitting on? What are the things that drive your business? If those aren't known absolutely categorically to the cent, then the job is not being done properly. Analyzing the costs, working out where you can take out cost from the equation, and then working out what you analyze, how you analyze the market as to where you see things going. For me, if the market is at 20 under front month, 20 under the second month, and the full carry is at 30, and actually you're coming up to a roll period and you don't want to be exposed to that front month, you've got to do something, because the exchanges don't want you in that front month. So there are timing issues as well, that a lot of companies, perhaps don't take into as much consideration. But there are also opportunities, and actually being able to handle physical delivery, if you're a futures market player, is something that is a very, very handy thing to be able to do. A lot of people are scared of it. And I think one of the things we try and show our customers is not to be scared of physical delivery in the futures markets. Warehouses are really no different to a CSD in an equities or securities market. They just happen to have bags of things in them, or piles of things in them, rather than quasi pieces of paper.
As someone who participates in markets a little bit, physical delivery scares me as well. So I think it's nice from your end to hear how you can be transparent with your firm when really understanding the market dynamics.
There's this myth.
Yes.
That in the markets, if you take delivery, suddenly 10 tons of cocoa or coffee or whatever it happens to be is going to turn up on your doorstep. It won't. It sits in a warehouse. It sits in a silo. It's in a tank. It's somewhere else. You've got to do something with it, but there are ways of dealing with that, and being comfortable with that, and at least understanding the mechanics is a really important part of understanding the full curve. Because if you don't understand that front piece of the curve, you have a very, very important part of the jigsaw that isn't really clear to you.
I want to know, what are some of the major lessons that you learned over your years? You have a lot of financial industry experience. What are some of the key things that you learned throughout these years?
I think not to be afraid of saying what you think. That's probably been as equally helpful to me as it has a hindrance. I'm not shy about saying what I think. I do think you have to go with your feeling on markets, but I also think you have to put in the time to understand the dynamics behind them, because if you don't understand the dynamics, you might as well just be throwing darts at a dartboard. It's a complex structure of lots of moving parts, and I think we need to have, if we're involved in markets, you have to have a feel, but that feel has to be based on research. It has to be based on your knowledge that you've done your absolute most to understand what you're dealing in.
And you talked about some of the lessons that you learned. I want to know also, what are some of the advice that you would offer to young professionals, someone who's just starting off in college, or young like you were in high school? Any advice to them?
I was young once, I promise. Advice: don't be afraid of trying something new. Don't be afraid of innovating. Don't be afraid of doing something that is different. That may be tech. It may be a trading strategy. It may be working with a different type of firm, a firm that has a different approach. the mainstream is not always right, and it's not always is perfect. It's not always perfect for everybody. So I would encourage the creative thought and innovation and collaboration. Collaborate with your peers. Collaborate with your colleagues. Teamwork is everybody talks about it. There are few people that do it well, and I think teamwork gets people a long way. And I think that you combine teamwork, innovation, creativity, and inquisitiveness. Be inquisitive. Ask questions. Make sure you go out and find the answers. Research those answers. Do it in your own time. Become more educated about the things that fascinate you, because that will stand you in good stead. And the other thing that's always been good for me is just be a connector. Be somebody that knows somebody who is there or is there. And it happens for me a lot that I happen to be the person who knows the man or woman or whoever it might be, CEO or CFO or manager or whoever at a company. I have made it my business to have those contacts and to build up relationships. They matter.
Well, I love that. The relationship building, taking time to learn things that you're truly interested in, your personal time. That's just not just what's required of you. Going after things you want and not being afraid to take risk, and always asking questions. I love that perspective, Clive. Well,
but the other side of that,
yes,
is don't do it all the time. Have fun.
Yes.
Because if you don't have fun,
yes,
you're going to wipe yourself out, but you're probably a bit boring.
Yes. Yeah. Well, we can't have that happen. You had to have, enjoy the little things in life, travel. I know all that's important too. Is clearing the mind and having fun, and because that's what this all is for at the end of the day too, is to live your life and enjoy the little things and the people around you. Well, we appreciate your time and your insights today, Clive, into the interesting world of Contango. Your experience and expertise provide valuable perspective into navigating the complexity of financial futures. Thank you for being a part of Futures Discovery.
My pleasure.
Congratulations. If you made it this far in the episode, it means you probably have a good understanding of the fundamentals of Contango. On our previous episode, we focused on cost of carry, where we witnessed some of the effects of rolling contracts in the Contango market. But on this episode, we'll go more into depth into how this information is used for producers, merchants, and investors as well. The quantitative data we'll use for today's episode is market data, the forward curve, and the basis report for Quorn. Let's first start by recalling the forward curve for Quorn. The forward curve we'll see right now is generated by Refinitiv using trading prices on contracts of Quorn with different expiration dates, but we'll be able to generate our own forward curve using the same information from the CQG trading platform. But let's briefly glance at the Refinitiv generated forward curve. So here the contracts with different expiration dates are on the left-hand side, and the same market data we'll use for the forward curve in a little bit right here. We'll look at the expiration dates 1 year into the curve, starting with Quorn contracts starting in 2024, March 2024, the most upcoming expiration. That's CH24, and we'll go all the way into 1 year. So that March 2025, CH25. And here we can see the futures price is higher than the spot price. So this is in Contango. So if we see right here on the forward curve, we have March CH24, which is exactly on here, is trading at $442. We can see that same data here, $442 for the CH24. And then if we go 1 year into the future, CH25, that March 2025 Quorn is trading at $487. I just wanted to recall what the forward curve looked like, how it's generated using contracts. And if you want a better understanding to make this forward curve yourself or analyze the data, recall our cost of carry video where we make the forward curve for Contango and backwardation scenarios ourselves. Okay, guys, so we've already generated the forward curve for the Quorn market that's in Contango. Now, this is very similar to the previous forward curve we generated on the cost of carry video. Same market data, same expirations, starting from Quorn that expires in March 2024 to Quorn expiring in March 2025. Now, previously we talked about some of the implications as an investor, but let's really focus on where this Contango market is coming from, what the cost of carry is meaning, and how merchants and producers use the cost of carry to understand markets and generate value. Let's take a look at this market from a merchant standpoint or point of view, okay? If I'm a merchant or a producer of corn, right, in the corn market today, and I see this market, there's not incentive for me to sell this market in corn, right, to sell my corn today, because I would only be able to sell it for $444. Whereas if I held on to my corn until a future date, I could sell it in 1 year now for $487, right? We see that. If I held on to my corn, there's more incentive to sell in the future than it is to sell today. But there is cost associated to holding on to corn, right? If you have a grain bin that holds all your corn, in order to keep that corn healthy, that grain healthy and fresh to be able to sell, you have interest rates, you have insurance costs, you have transportation costs. So there are real costs associated with holding on to that corn until, let's say, 1 year from now. And so this is what the market is trying to tell us, right? That this is the cost, right? We see this jump from each expiration. This is the cost associated with holding on to your grain or to your corn until that next expiration date. And so if you're a merchant or you're a producer, you're trying to beat what the market is saying that the cost to carry is, right? And so let's say right here it says the cost to carry is from $444 to $455. That's an $11 jump. If you can beat that $11 difference in your cost to carry, right? Let's say you can do it for $9. You have now just grading that $2 difference from what the market is telling you the cost to carry should be and what you're able to actually pay in the cost. And so from that $11 gain minus the $9 that you're really having to pay, you get a $2 profit from what the market is predicting and what you're able to produce. And so that's the market for merchants and producers. And in the Contango market, that's what merchants and producers are trying to do. They're trying to find ways to mitigate their costs and buy and sell later in the future at these different expiration dates, as long as they're able to beat what the market is predicting the cost to carry to beat. Now, of course, they won't always be able to do this, and they'll still have to sell in those markets. But that's the game for merchants. That's the game for producers to capitalize on the different market dynamics. Okay. Now let's talk about this from an investor or a trader's point of view. And let's just first start off. Let's say I'm inherently long on corn, right? I think corn is going to go up even farther. I'm more bullish than even what the expirations are saying. They're going to go up in the future. And let's say I want to participate in this market, and I'm already a participator. Let's say I'm a participator right now, and I'm in this. I currently have a March 2024 contract, right, that I'm waiting to expire, and it's about to expire, and I want to stay long in this market. I want to continue to participate in this market, but when this CH24, when this March corn contract expires, we said this hypothetically last time that until expiration, markets didn't move that much, right? We see a little swigglies from maybe a little market movement, but it's mostly consolidated. And then the next jump we see is into the new contract, right? And that can happen, and it does happen, and it's a hypothetical way of thinking about things if you're looking at the market today. So let's start again. Right now, I'm inherently bullish on long corn markets, and I want to stay in the market, but my CH24, my March corn contract is back to expire. In order to stay in this market, I have to buy here. I have to buy at this price, and I have to sell at this price of $444. So I'm buying low. No, I'm selling low and I'm buying high. In order to get back in this market, I've just lost money. I've just lost $11 by having to roll this contract into the future. And so that's what rolling contracts mean. It means that you're rolling this front month contract into a back month contract because it's near expiration. You want to stay in the market. You want to continue to be a participant. But in the Contango market, the futures prices, the prices that are in the back month are going to be more expensive than the front month. Therefore, you're going to have to buy high and sell low. You're going to have to buy high and sell low, and that can really bite into your profits. And we call that negative roll yields, because you're losing profits as an investor being inherently long on this market and want to continue to participate. Now, there's other ways to be in this market. If you're a trader or an investor, you can do something that's called spread trading. And so let's say, well, I'm not really worried about the price of corn as much. I'm more interested about the cost of carry just from an investor standpoint, right? I'm not gonna hold on to the grain myself. I'm not a merchant or a producer, but I do have thoughts about what the cost of carry is gonna do. And so let's say I inherently thought that the cost of carry was overpriced. It was selling at a premium. Well, what I could do is I could buy this front month and I could sell this back month right here. This one's far out, but we just say that, it's pretty far out. I have two opposing trades in the market, right? In the same market, I'm selling and buying the same underlying asset. And so that limits my exposure to any anomalies. If anything changes that really shakes the foundation of just the Quorn market, I'm still hedged in that I'm both long and short the same underlying asset. And right now, I'm really just playing with the cost of carry effect in the market. And so if I thought the cost of carry was gonna go down, by selling this back month, I'm saying that this is selling at a premium, that it's overpriced right now, and that as the months continue to go on, weeks continue to go on, market's gonna correct itself and start knocking off the price of this cost of carry because it's overpriced right now and selling at a premium. And that's what spread traders are trying to do. They're trying to understand what the cost of carry is, what the full carry is, and if they think it's overpriced, underpriced, and what the spread dynamic is to make informed decisions about the market.